If you buy this one ETF and hold it to retirement, you'll retire with almost $1.5 million that could generate you 6 figures of income each year during retirement. I'm your Uncle Paul, and I'm going to share with you why investing in the S&P 500 and holding it forever will give you the financial freedom you're looking for. So here's our retirement calculator, and I'm going to show you these numbers. Guys, this assumes you start at the age of 35. Now let's say you buy this low-cost ETF and you generate the long-term market returns about 9.5%. It's between 9 and 10%. You start with $6,500 and it compounds. And at the age of 65, you end up with $1.4 million in your retirement account. Guys, the biggest thing is you can do this without a financial planner. That's what's so wonderful about this. You don't need some financial planner that's going to say to you they can beat the market. They can't. They cannot beat the market. Most active investors can't beat the market. You can do this by yourself and match the market step for step along the way without any extra thinking.
So what exactly is an ETF? Well, the point of it is to mitigate risk. What you're doing is taking a bunch of stocks, and in this instance, I'm going to use the Vanguard 500 ETF. So it's called, the ticker symbol is VOO. And what that does is take 500 companies from the S&P and put them into one ticker symbol. And that is what runs for you. So when we say the benchmark on the market, that's the S&P 500. What you're doing with an ETF is buying all 500 companies. Here's the good thing about it. The good thing is you're mitigating risk. Let's say that one of those 500 companies falls 30% in a day. That's a big drop. And if you own that individual stock, you're obviously getting hit 30%. Now, you also have other stocks that are up 15, 20, maybe 30%, and that balances everything out. So the historical return on the S&P 500 over the last 100 years is about 9.9%. So that's what you can expect to make. Now, here's the downside, if you want to look at it this way. Let's say that a stock goes up 30%. Well, you don't capture all of that because there's other stocks that are down that day. But it's all a balancing act. And the point of this is, over a long period of time, you're going to have a very secure, pretty well-known return. And that is the point of an ETF.
I love a financial planner that says, listen, our goal is to get you to this much money, and we're going to put your money into low-cost ETFs that get you there. What I have a problem with is when financial planners think they're going to pick stocks better than the average person. They can't, guys. Look at these mutual funds out there that are run by Harvard MBAs. These guys have research team and analysts and all these things. They spend tons of money that come out of your pocket as an investor in order to try to beat the market. And guess what? They can't. Only 82% of mutual funds on a year-by-year basis beat the market. Over a 10-year basis, it's in the low single-digit percentages. And before you think you're going to pick those individual mutual funds out like Dave Ramsey claims he can do, just remember that the best performing mutual funds in a 10-year period will have 2 or 3 years in which they're in the worst performing mutual funds. Why? Well, think about it. In order to beat the market, you have to think different. And in order to think different, you have to invest in things that go against the crowd, which means you're going to have major underperformance. Look at everybody criticizing Warren Buffett. At every market peak, if you look at the previous 3, 5, 10 years, Warren Buffett will trail. But guess what? He ends up coming through at the end. Why? Because he sticks with the right investments. But I hear it time and again from everyone I know. Why do you like Warren Buffett so much? Look at his past performance over the last 5 to 10 years. He's terrible at investing. I bet you're hearing that a lot right now. So what does Warren Buffett even suggest to do? Buy a low-cost ETF that basically matches the market. In a previous video, we looked at SCHD, which on Twitter has an amazing community of followers. But the thing they have to remember is, in the last 11 or 12 years, SCHD has trailed the S&P in total return, including dividends. Now, a big chunk of that was in the last year, so I understand the argument that SCHD is still going to do well. But even up until the last year, it minorly trailed the S&P. Not only that, though, the more dividend you have, the more you will pay in taxes if your money is not in your IRA or 401k. Now let's compare two of the most popular S&P 500 ETFs, SPY and VOO. In these two ETFs, one is by Vanguard, which is VOO, and one is by SPDR, which is the SPY. Look how similar they are. 504 holdings to 503. Go down below, their returns are exactly the same. The dividend yield of 1.5% is exactly the same. The only difference is the expense ratio. Now, those of you out there might sit there and say, oh my gosh, SPY has tripled the expense ratio, which is true. But remember, 0.09% on every $1,000 you put in there is 90 cents per year versus 30 cents per year. Now, obviously, I'm all in favor of saving money, but we're literally talking about pennies every single year that over the long haul will matter very insignificantly in your retirement. So guys, if you're enjoying this content and learning a lot, do me a favor, hit the like button and subscribe to our channel. We talk about businesses, real estate, stocks on a daily basis, and you'll get a lot of information from us. Now, between these two ETFs, the reason I like VOO better is because one, it's Vanguard. It is well known in the area, in the industry for low cost, pro investor kind of performance. And two, if you're the kind of person that wants to sell puts to gain some additional income while you're waiting for the stocks to go down, VOO has better puts. More on that from Mo just a little bit later. All right, now guys, here's how you retire with many, many, many millions of dollars more. As I told you guys before, this is our retirement calculator. Now, what I'm going to do is I'm going to start from the beginning and start with all new assumptions. If you're age 30 and you want to retire at 65, that gives you 35 years of saving your money and saving for retirement. And let's say your current savings are about $50,000, okay? Now, every year, you're going to put some money into an IRA, or you're going to put some money into a 401k, or some combination of both. So let's say you're able to save $10,000 per year. And you're going to increase that by 3.5%, let's call it 4% a year, because as you're younger, your income should increase at a faster rate as time goes on. Now, let's say we get those 9.5% returns, and then during retirement, you take a little bit back and you make about an 8% return, because you're going to shift some things around, probably be less volatile because you need that income in retirement. And let's say you expect to live to age 95. That's a long time, guys. But remember, as time goes on, the average age of living will probably extend further and further. So just remember that. You're going to live a lot longer, and I'd rather have you be more conservative and put a later age in life. And let's say inflation is about 3% a year. And let's say you currently make about $80,000 a year. So you're only saving $10,000 of that $80,000, which is about 12.5%. I always encourage people to save as much as possible. Absolute bare minimum should be about 10%. But you should try for 15%. And also remember, this annual savings doesn't include any employee match in your 401k, which is awesome. Okay, now what percentage of your income do you want to have in retirement? Guys, there's a lot of theories out there. In retirement, you're probably gonna have a paid off house, probably have a paid off car, higher health expenses, probably more travel. So I always tell people, just be conservative and say, hey, I wanna have the exact same income in retirement that I had the year before I retired. So we hit the generate button, and here's what's so great about a retirement calculator. It's gonna tell you immediately, do you have enough for retirement? The answer is yes. The big difference with our retirement calculator versus all the others out there, we go all the way past retirement. Your average financial planner will say, look, you're 65, you have $5.5 million. Of that, you're probably gonna generate over $100,000 a year in dividends. And if you are learning how to write covered calls, which Mo will show you later, you can generate another $100,000 to $150,000 a year off of that $5.5 million. You can generate $250,000 a year in extra income. What will you need to survive? Look at that next number. $231,000 to be pulled out for retirement. You can cover all of that with just the dividends and the covered call income from your retirement. And here's the best part, guys. Assuming you don't even do covered calls, you're gonna pass away at the age of 95 with $18.3 million, which means you can actually spend more in retirement than you spent during your regular life. How much more? Let's guess here. Let's say you want to spend 150% of what you made. So you're gonna spend more money in retirement than while you were working. You still have enough to live. You actually pass away with $582,000. So basically almost broke, but spending 50% more. That's how amazing the power of compound interest is. Want me to blow your mind a little bit more? Let's say you're out there and you're 25 years old and you have no savings currently, but you can save that $10,000 a month, a year. Generate, you have enough money, and now in retirement, you have $6.6 million starting 5 years earlier without the extra $50,000, and you have more money. Isn't that incredible? Now, let me tell you what happens if you hire that financial planner who puts you into high-cost mutual funds. Let's go back to our situation of age 30, and just spending 100% of our retirement, but now, instead of a 9.5% return, first off, they're charging fees, 1%. Secondly, the mutual fund's not gonna match the market. Let's say it misses by another percent, 7.5% return instead of 9.5. Generate? Guys, I have bad news for you. Now you don't have enough to retire. You need to save $3,000 more per year. That's an extra 30% on top of what you're already doing. So instead of having $5.5 million in retirement, you have $2.7 million in retirement. That costs you $3 million by having that expensive financial planner, and those expensive mutual funds are gonna put you in. And instead of dying with 18 million bucks, you now basically die with a negative $8 million, which means you can't live. You are broke at the age of 83 or 84. What sounds better, guys? Managing your money on your own and just putting money away in a low-cost ETF, or buying these expensive mutual funds that every financial planner out there is gonna push you towards?
So there's an additional way that you can make income every single month that is going to really benefit you, and there's possibilities that you can make 6 figures a year in addition to everything else that you're doing, and that's by selling options. Now, people hear the word options and they think, wow, this is risky. This is what people were doing in 2020, 2021 and losing a lot of money. Making a lot of money, but also losing a lot of money because it can be risky. But if you do it the way that I show you, selling puts, selling covered calls, it is a much less risky way and a great way to collect an income. Okay. Let's go right here, and we have VOO, this is our Vanguard ETF. So here's the principle behind selling a covered call. The objective is to give somebody the option to take the shares away from you that you own, in this instance, VOO, at a certain price that you determine and write an options contract at. So let's make an example. So the current price right now is $386.71. Let's say that we want to write a contract further out, say 51 days out. This is the day that we're going to choose right now, December 15th. And we're going to go at some type of strike price, maybe $420 a share. We'll determine that in a second. But in this example, you're giving somebody the option to take those shares away from you at or above $420 a share. So if VOO goes to $435 a share, you're losing that $15 of opportunity cost. That's the risk of covered calls. But you're gonna collect a premium. Now let's go do a real example. So in the example that Paul gave, somebody had $1.45 million. So what I'm gonna do is simply this for the example. I'm gonna say we're gonna take $1.45 million and divide that by today's current share price. And let's just pretend that's how many shares that we have, okay? We're only gonna be able to buy 37 contracts. 50 cents is the bid, 60 cents is the ask. That middle number is 55 cents. That's the limit order that you're gonna put in. I know that I'm throwing a lot of things at you right now. This is not something that you're gonna watch one time and say, hey, I'm comfortable with it, I get it. Options can be very counterintuitive. When I first started doing this, somebody had to explain this to me 4, 5, 6 times, and then boom, it became routine, it became incredibly easy. We also have options courses here at Everything Money that you can take. But let's go through here and say 37 contracts, which is 3,700 shares, and we're gonna multiply that by 55 cents. So what you're gonna collect is $2,035 for writing that contract. That's the premium that somebody is gonna give you for taking that chance and writing that contract, knowing that there's an 8% chance that this outcome occurs. So again, if the share price is below $420 on December 15th, you keep your $2,035, the contract completely expires. If the share price is over $420 at that point, you're going to lose those shares at $420. So that's kind of the risk of covered calls. But if you do it in a way where the deltas are low, you can continuously do this month in, month out, month in, month out, and you'll notice how much money you can actually incur over a 12-month period. So even though I invest in individual stocks in my brokerage accounts, what I do for myself and my family in our retirement accounts is we go with ETFs. I want to take all of the thinking out of it. What I'm trying to do with those retirement accounts is get to the end, 65 years, 70 years, whatever it is, and take that money out and have a pretty good idea of what it's going to grow to. So even somebody that is a stock picker in their brokerage account, they can go to a retirement account and say, you know what, I'm going to put everything into the S&P ETF and just let this thing run. And I think that is a great opportunity for those of you that don't want to do the work to pick individual stocks.
I strongly encourage you to re-watch this video over and over to get it into your head, like it took me to get into my head, that a financial planner, although they're great for providing a plan, when it comes to the investment they put you in, they tend to underperform and to be expensive. And that's the worst thing you can do as you save money.